Hello, this is just a short presentation on the carbon credits program that Intricate has introduced into Alberta. One of the things that we'd like to start by doing is just explaining that carbon credits get a lot of airplay. They get talked about in a variety of different terms by a variety of different people. When we're talking about carbon credits, we're talking specifically about credits that are generated through the voluntary adoption of technology that will reduce your greenhouse gas emissions. As soon as those technology changes are no longer voluntary, there's no longer an opportunity to generate carbon credits. So it does need to be something that you're undertaking before the regulation actually comes into play. It's a very well regimented program. There are specific protocols that need to be followed. Carbon credits require third-party verification. They get serialized by a third party. And then those carbon credits can be sold or traded in Alberta. Depending on the protocol that's being adopted, they may be traded in other jurisdictions, either in Canada or overseas. Intricate is pleased to be involved in this process in a variety of ways. There are essentially two different ends of the spectrum, and we're quite happy to play at either end of the spectrum or somewhere in the middle. At one end, Intricate can simply be the service provider. So we're happy to work with you to determine what sort of eligibility there is to generate carbon credits at your facilities or in your business, and then we can work with you either as a project manager or simply a contractor to perform specific work, and that can be the end of Intricate's involvement. At the other end of the spectrum, Intricate is able to come in and invest 100% of the costs related to adopting the technology that begins to generate those carbon credits. And then we're quite happy to work also with you anyway in between with any sort of a shared model. So we can be a partner investing 50-50, 60-40, 70-30, whatever suits your business's needs. Our goal in this is to be completely transparent and to try and demystify the process of actually calculating the credits and generating the credits so that you've got confidence that you're making the right decision for your business. Carbon credits get monetized in a few different ways. The first and the lowest risk option is an offtake agreement. And one way to think about this is just as a futures contract where you agree to pre-sell your carbon credits for a fixed amount over a fixed period of time. Now, those are typically discounted because there is an elimination of risk, and so it's important to be aware of that. But that's something that we're quite happy to talk with you about on a case-by-case basis. The next option is just a spot rate sale, and that's just selling at the time that you feel comfortable selling the carbon credits. And so there is an opportunity to participate in this market the same as you would participate in any other commodities market, and the prices fluctuate up and down depending on the specific demands and supplies of the specific time that you're looking to sell. And then the third option is just to use the carbon credits internally, and that allows businesses to reduce the amount of carbon tax that they pay. So the protocol that we're really focused on right now is the conversion of high bleed instruments and devices to low bleed instrument and devices. So this is something that will generate carbon credits up until December 31st of 2022. So we've still got approximately 22 months of opportunity here to generate carbon credits before the technology is simply a regulatory requirement. So really what's involved is just going through a facility, identifying high bleed instruments and replacing them with low bleed instruments and devices. What's really, I think, fantastic about this opportunity is that it generates positive cash flow if it's installed in the next 3 to 6 months. So you do need to be able to generate enough carbon credits, and that requires enough time to generate enough carbon credits for it to be cash flow positive, but it can generate positive cash flow. We've worked up 3 different scenarios or sample calculations just based on a typical plant environment and and we've got the assumptions documented. We've done 3 just to kind of show the effect of those 2 ends of the spectrum, where Intricate is a service provider, or Intricate is the investor, or kind of that middle case where we find some version of sharing the investment that works for both parties. So the first example that I've got here is just the carbon credit partnership model. Now, the key assumptions here relate to the price of carbon per ton. So these have been discounted from what the statutory rates are. So this does assume a low risk offtake agreement being in place, so that the carbon credits are sold at kind of the lowest realizable value that we'd anticipate over the next couple of years. Because this is a protocol that winds down at the end of 2022, there is limited risk in this market. We've got pretty good fundamentals in place that mean that we're not going to see any massive structural change to the market in the next 18 months or before the end of 2022. We've included the cost of third-party verification of the credits, and then there's a third cost on here that you'll notice in the key assumptions, and that's the value of the fuel gas that's saved. Now, this we've included in the ROI calculation in one scenario, and then we've got a second version that doesn't include it, because we know that it's not always possible to realize the value of that gas at market rates. So in this option where Intricate is simply a service provider, we perform the work. It's approximately $587,000 worth of work, including labor, equipment, and materials. And then it starts generating carbon credits. The carbon credits are reduced in 2021 versus 2022, just because we've assumed 3/4 of a year instead of a full year, because we have actually gotten into the beginning of calendar 2021. And then the value is just based on those key assumptions up above. So over the course of this project, the full service costs are $587,000. The third-party verification costs $36,000. The carbon credit value is $1.16 million, which creates a net cash flow of $538,000, or a 92% ROI on that initial investment of $587,000 over those 2 years. If you add back the value of the fuel gas saved through installation of low bleed devices, then that can increase the cash flow potentially up to $725,000 over those 2 years, which just further pushes up the return on investment. So the next option is looking at a shared investment opportunity, and what we've done here is we've said, okay, there's a cost to installing this equipment. We're going to split that cost 50-50 between you and Intricate. We're assigning you an additional share of the carbon credits of 20% just off the top to recognize the fact that you as the facility owner are actually providing the opportunity to generate these carbon credits. So what that means for you is that the investment cost is down to $252,000. That essentially is 50% of the number that we saw on the first page, the 587, with profits removed, because we do look at this strictly as cost if there's a sharing of the risk and opportunity between both of us. So the carbon credits produced remain the same, and the value of those carbon credits, or the cash realized from those carbon credits, is reduced to represent 20% of the total carbon credits plus half of the remaining carbon credits. So basically another 40%, which means that you'd be getting 60% of the carbon credits. Intricate would be collecting 40% of the value of those carbon credits to recover its initial investment in the facility and the risk that it takes on. So that produces a net cash flow over those 2 years of $426,000 with a return of 169%, because of the reduced investment up front on the cost of labor, equipment, and materials. And then adding back the fuel gas, that's precisely the same amount as the first scenario, and that would increase the net cash flow to $612,000 and bump up the ROI to 242% over those 2 years. The third scenario is with Intricate making the full investment, and so this is a little bit of a rare scenario, but it's something that we're quite happy to work with you on. In this case, we haven't calculated an ROI because there's simply no investment on the part on your part. Intricate provides all of the labor, equipment, and materials. There's no invoice out to you at all for the cost of that upgrade, and then what happens is 20% of the carbon credits generated go to you to represent the opportunity provided, and that represents a cash flow of $232,000 or $419,000, including the fuel gas savings. So that's kind of the three different scenarios that we've put together. Again, our intention is to be completely transparent and to really work with you as a partner on this. And so we'd welcome the opportunity to discuss your specific requirements in person or virtually. Please don't hesitate to reach out with any questions or concerns. Thanks.